Welcome to today's deep dive. Our mission today is to unpack a really dense quantitative research paper that puts a legendary piece of financial wisdom to the ultimate test.
Yeah, it really takes a classic heuristic and subjects it to hard data.
Exactly. You probably heard Sir John Templeton's famous rule bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria.
Right, it's a staple. But we are exploring a fascinating premise for you today. Can human emotions actually be mathematically mapped to predict those exact market cycles?
Okay, let's unpack this because traditional economic theory generally assumes that markets are perfectly rational.
That asset prices instantly reflect all available data, basically.
Yeah, but Templeton's behavioral life cycle throws a massive wrench into that. It suggests that collective mass psychology is, really what's driving the bus.
What's fascinating here is that historically, measuring that collective psychology was just a subjective guessing game. But today, the researchers show we can rigorously quantify it.
Using tools like the VIX, right? The market's real-time fear gauge.
Exactly. Let's look at phase one of Templeton's cycle. Pessimism. The data reveals that when the VIX violently spikes above a level of 80,
Which we saw during the 2008 financial crash and again on March 16, 2020.
right, it signals total psychological capitulation. And at that extreme level, it's no longer about human sentiment.
It becomes mechanical. It's not just people feeling nervous anymore.
Precisely. Options pricing blows up, and algorithms trigger massive forced liquidations. Margin calls systematically purge the weak hands from the market.
So mathematically, that maximum limit of fear, where the selling pressure literally exhausts itself, almost perfectly pinpoints the exact birth of a new bull market.
It creates a structural floor, yes.
Here's where it gets really interesting. So if an 80 on the VIX clears out the market, what happens to all that cash? Do people just jump right back in for phase two, the skepticism phase? I noticed the paper mentions a neutral sentiment anomaly right around here.
They definitely don't jump right back in, and that anomaly is key. You might assume that unusually high neutral sentiment means investors are just carefully weighing their options.
But they're actually just terrified.
Yes. The paper shows it actually represents massive amounts of undeployed cash parked on the sidelines by deeply traumatized investors. They are terrified of getting burned again.
It's like watching a friend make a really risky bet at the casino. You hold your money back, waiting for them to lose, but as the market slowly climbs what analysts call a wall of worry, that friend just keeps winning.
That's the perfect way to look at it. The psychological pain of missing out eventually forces all that sideline cash back into the market.
Massive FOMO.
Exactly. And that staggered, reluctant re-entry is exactly what fuels the sustained rally into phase three. Optimism.
Which the paper notes is where the vibe really shifts. In phase three, it's not just reluctant money anymore. This is where investors finally see the hard data validating the rally.
Right, GDP stabilizes, corporate earnings actually meet expectations, and that wall of worry starts to crumble. Institutional capital feels safe enough to deploy at massive scale.
The macroeconomic reality finally aligns with the stock prices.
But that broad comfort inevitably metastasizes into the incredibly dangerous phase four. Euphoria. If we connect this to the bigger picture, euphoria completely defies fundamental mathematical logic.
Oh, totally. Look at the 2021 meme stock craze the researchers analyzed.
You had massive waves of retail liquidity pouring in, but they weren't just buying shares. They were heavily manipulating the options chain.
Which triggered those massive gamma squeezes, forcing market makers to buy the underlying stock just to hedge their own risk.
Precisely. That feedback loop temporarily shattered fundamental pricing models. It drove highly distressed companies to stratospheric valuations.
Purely based on social media momentum and mechanical market structure, entirely divorced from reality.
Exactly.
So what does this all mean for you? How do you actually use this information to navigate modern information overload without getting caught in that euphoria?
It comes down to a fundamental asymmetry in market timing. Fear is simply a much better timing tool than greed.
Because fear is mathematically bounded.
Right. When asset prices plummet, algorithms hit hard limits, and forced selling eventually hits zero. Because of that structural floor, extreme pessimism is a highly reliable buy signal. Greed, however, is entirely unbounded.
A market can remain irrational and euphoric much longer than rational investors can stay solvent trying to bet against it.
Exactly. But this raises an important question. Should you rely blindly on sentiment data to time the bottom?
Well, looking at July 2008, the answer has to be no. The data showed extreme statistical pessimism at the time, A strict contrarian would have bought heavily, assuming it was the absolute bottom.
And they would have been wiped out. That pessimism failed to prevent another 30% market collapse because the fear wasn't just psychological.
It was entirely justified by a severe structural economic crisis. Sentiment is a powerful lens, but it cannot override a broken structural economy.
It's a crucial distinction.
And that leads to a final thought for you to explore on your own. The paper notes that natural language processing models like Finbert are now constantly scanning financial headlines in social media to algorithmically trade on these exact emotions in milliseconds.
It's happening faster than humanly possible now.
Right. So if trading bots are increasingly programmed to read, anticipate, and instantly react to human sentiment, will the market cycles of the future actually still be driven by human psychology? Or will they be entirely driven by the AI algorithms amplifying it?